Hey guys, I hate to interrupt, but I just wanted to take a moment to say if you're studying for the CPA exams and you like the visual learning approach that we take in this video, definitely check out Universal CPA Review's free trial. You can do this by going to www.universalcpareview.com, or you can click on the link in the description of this video. From there, you could take a sneak peek at Universal's platform, which includes animated video lectures, study guides, and practice questions with task-based simulations that come with video explanations that walk you through the solution step by step, kind of like having a tutor by your side. Okay, enough of that. Let's get back to it.
All right, so now we're zeroing our focus in on net pension liabilities for a defined benefit pension plan. Okay, so at this point, we are familiar with financial reporting for pension plans as they pertain to for-profit companies. But now we're talking about the financial reporting associated with pension plans from government employers. Okay, so in this case, Franklinville is the government employer who is setting up a pension plan for its employees. So let's recall what a defined benefit pension plan is. Well, this is the liability that the government will have as they now owe employees for the distribution at a later date. So a net pension liability is going to be for a defined benefit pension plan, which represents the amount by which the total pension liability exceeds the assets, aka the money that is being invested, which is set aside in the pension fund to pay current and future pensions, also known as the pension plan's fiduciary net position. So in other words, if there is a shortfall between the total amount a government is expected to pay its retirees and the amount that it currently has, that shortfall is the amount that is recorded as a liability on the entity's financial statements, hence the term net pension liability. So to give you an example, if Franklinville has promised $100 million in pension benefits to its employees, that is the total pension liability. But if it currently only has $80 million set aside in its pension fund, then this would be reported as a net pension liability of $20 million. So there are two things we need to focus on within this topic. We need to recall the recognition and the measurement requirements for a net pension liability. So if we're thinking about the recognition requirement, we now understand that governments have to report a net pension liability in their financial statements. And this is simply the difference between what they owe in future pensions, aka the total pension liability, and the amount that they have set aside to pay these pensions, aka the pension plan's fiduciary net position. Okay, so this is how Franklinville needs to recognize the net pension liability in its financial statements. So now thinking about measurement. Okay, so this involves calculating the total pension plan liability and the plan fiduciary net position, and then finding the difference between them to get the net pension liability. Okay, so the total pension liability, this is the total amount owed to employees. So let's say that based on current employees, their years of service, and the terms of the pension plan, Franklinville's actuary has calculated a total pension liability of $500 million. This is the present value of the projected benefit payments attributed to past periods of employee service. So that's how we're going to measure total pension liability. All right, so what about the plan's fiduciary net position? This represents the resources that Franklinville has set aside to pay the pensions. So let's say that Franklinville has a pension fund with $400 million set aside. This is the plan fiduciary net position. And then finally, we have the net pension liability. This is the total pension liability minus the plan fiduciary net position. Okay, so in this example, Franklinville would have a net pension liability of $100 million. All right, so again, we're circling back to how this is going to be measured. This is our measurement principle. Okay, so a few other things to keep in mind. The discount rate. The total pension liability was calculated using a discount rate. So this rate was based on the long-term expected rate of return on pension plan investments and the yield on high-quality municipal bonds, right? So let's say the actuary used a discount rate of 5%. Franklinville's financial report would also include a sensitivity analysis showing the net pension liability and how it would change if the discount rate was, say, 1% higher or lower. If the discount rate was 4%, the net pension liability might increase. because future payments are now worth more in today's dollar. And if it was, let's say, 6%, then the net pension liability might decrease. Expense recognition. Franklinville would recognize pension expenses on its actual based financial statements. So this expense would include things like cost of benefits earned during the year, interest on pension liability, and any changes in the net pension liability due to changes in benefit terms or differences between actual and expected experiences. All right, and last but not least, we have deferred inflows and outflows. So if Franklinville's actual return on pension plan investments was different than expected, or if there were changes in actuarial assumptions, then these would be reported as deferred inflows or outflows of resources.